Lauria, president of Mercury Associates, suggests fleet managers look outside the box when looking for ways to save money by cutting costs, which continues to be the hottest topic in the business, and that includes looking at financing new vehicles instead of buying outright.
Cost containment, cost control. In an economic downturn, most organizations shift away from strategic thinking to tactical thinking. So 18 months ago, there was lots of discussion about sustainability, about green fleets. Those discussions still occur, but they're tempered by the reality that organizations are looking to reduce costs. So right now, in our experience, most fleet managers are looking to survive the next fiscal year. We don't see a lot of organizations interested in strategic planning. There certainly has been a reduction in the interest in information technology. You don't see as many organizations shopping for new fleet management information systems that are going to cost potentially hundreds of thousands or even millions of dollars. So it's much more tactical than a strategic focus, and that's directly attributable to to the downturn in the economy. We've seen that in past recessions. We get a lot more requests for proposals for fleet right-sizing studies, for evaluations of alternative financing, such as leasing versus buying vehicles, things that can have an immediate impact on an organization's budget, and less interest in business process evaluations aimed at identifying how an organization can become more eco-friendly, more environmentally responsible. When management is proposing to slash funds for fleet replacement, we strongly encourage you to think about changing the way you're financing the acquisition of vehicles rather than simply curtailing the acquisition of vehicles. For example, an organization that normally spends, let's say, $1 million a year, take a small fleet, on vehicle replacement, and management's proposing to let that organization spend $200,000 next year. That organization, if it's been financing the acquisition of replacement vehicles through outright cash purchase, by shifting to a lease model, could acquire $1 million worth of new vehicles, and if the average financing period is 5 years, the cash outlay required would be $200,000 or less. So the choice is, do we only replace $200,000 worth of vehicles when we really need $1 million, or do we replace the $1 million but we change the way we're paying for it? So that's an area we actually characterize that as the lowest of the low-hanging fruit in terms of immediate cost reduction. An organization that spends $1 million a year on fleet replacement is not going to wring $800,000 worth of cost savings out of improved business processes, more efficient ways of managing and maintaining vehicles. So to have the potential to generate $800,000 in real budgetary savings in the next budget year simply by going from what we call a pay-before-you-go approach, like outright cash purchase, to a pay-as-you-go approach, like leasing or lease purchasing, loans, represents a significant opportunity to save money without undermining the age of the fleet and the total cost of ownership of the fleet. Clearly, there have been some pretty dramatic changes in the financial markets. The days of easy money and easy credit are gone. And so what we're seeing is leasing companies and lenders being much more cautious about who they will do business with, doing much more due diligence, and being much more concerned about mitigating their risks. So sure, one of the advantages of floating rate financing is that the lender doesn't get locked into an interest rate if the cost of their borrowing increases in the future. So there's a certain amount of fear, and that's being translated into a lot more caution on the part of lenders in what organizations they will deal with. I mean, it's unfortunate because at a time, for example, when it's easier to make the case to government jurisdictions that historically have paid cash for the outright purchase of vehicles, that they should really take a hard look at leasing. It's probably going to be a lot more difficult for those types of entities to secure lease financing or lease purchase financing, particularly the ones that are having significant fiscal challenges. we've made some inquiries on behalf of some state governments, for example. Would the leasing industry be interested in having you as a customer? And the answer is not an unequivocal yes. And it's an educational process for us. A lot of organizations just assume that the leasing companies are interested in having their business, and it doesn't work that way. It's not. It's much more of a bilateral negotiation than a lot of organizations might think that haven't worked with the leasing companies before.